I'm going to take you through an opinionated way to run a fundraising process. This isn't a 5-minute video. It's going to go into a little bit more depth. So definitely, if you're interested in fundraising as a startup, set aside a little bit of time. Let's get into it. So first and foremost, when you are looking to fundraise, you should really set aside some time because you want to get it right. Now, first of all, there's a number of things that you need to understand that investors have a little bit of an advantage in terms of how they do this. And this is primarily because investors end up spending a lot of time looking at founders, looking at startups, and so they have a lot of investment experience. Whereas a lot of times founders, they're only investing, or they're only looking to get investment for the very first time. There's a lot of inequality of data and information. Obviously, investors see deals all the time. They see the valuation of a lot of companies. And investors have an abundance of inbound companies. So they see a lot of deals, they see a lot of ideas. So you're pitching your idea for the very first time, whereas an investor may have already seen similar ideas, similar concepts 5, 10, even 20 times. And lastly, investors have a large tolerance for the passage of time. And so it's not a big deal for an investor to wait a month, wait 2 months, wait a quarter, or even longer. Whereas for an early stage founder, the passage of time is kind of a big deal. And so you want to move those things along. Now, a founder can normalize some of these things. And so one is information. And so there is a lot of information on investors and funds. And if you spend some time researching, collaborating with other companies and startups and doing a little bit of your homework, you're going to be in a better spot in terms of understanding what the norms are. Number three, there's actually scarcity of amazing founders. And so if you can hyper target who you are looking for from an investor perspective, you'll realize that there's actually not a ton of companies on the other side of the equation. And certain investors are being very precise in terms of the types of startups that they actually want to invest in. Lastly, we'll talk a little bit about the mechanics of urgency and how to create some of that urgency. Now, if you haven't seen some of my other videos, I do have other content on some of the basics behind angel investors and venture capitalists. You can watch that video. I'll link it below. But very high level, different size checks, different individuals who are making the decisions, different structure in terms of time to close, different time to liquidity, and sometimes even different financial vehicles in terms of how people invest. So definitely think a little bit about that. Now, in terms of the language, it's really important that founders use the right language when they are fundraising. Oftentimes people commingle these terms and they are really used distinctly amongst investors. Typically pre-seed is very early. It's one of the very first investments. They're very frequently less than $1 million. I have seen them more than $1 million, but very frequently they're less than $1 million. This is typically investing off the idea, the team, maybe an MVP, maybe some early validation, but very largely folks who are investing at pre-seed. And this can be both angels, this can be accelerators, there can be pre-seed venture capital investors. They're very largely investing in the team. At the seed stage, you're typically looking for a little bit more capital, usually 1 to 5 million. You usually have some type of validation in terms of your product. There's usually some repeatability. There's some validation in terms of what you're doing. There's typically some revenue, usually under $1 million. And then obviously Series A is later. Now, if you look at norms, this is from AngelList. This is Q2 of 23, so relatively recent. And this shows the average pre-money valuation. And so it's important that founders understand what the norms are in the industry so that when they are ballparking expectations or they're having a negotiation discussion with potential investors, they're anchoring their assumptions based on norms. They're not guessing, but they're looking at the market data in terms of what's actually happening. You can also see what peer companies are raising. Again, 25th percentile, so closer to the bottom, we're seeing pre-seed fundraises at a $5.5 million valuation, 50th percentile closer to 8, and then certainly at the top of the spectrum, you're at 12.5. Again, There's obviously a range behind these, and there's certainly a number of companies that actually fail to fundraise that aren't represented in this data as well. This is only from companies that were able to fundraise. So just keep that in mind. Seed companies at the $10 million to $16 million, and then at the high end at 24. So sometimes you'll see these TechCrunch articles or other articles where a founder is raising at a crazy valuation. And yes, that does occasionally happen. But just understanding where the norms are is going to be helpful for you when discussing pricing evaluations with potential investors. I'm not going to go into Series B, but obviously you can look up data beyond that as well. In terms of the types of deals and how people are actually investing, there's kind of a mix of safes, equity, and debt. This is not normalized across stage, and so I would very highly suspect that pre-seed has a much higher percentage of safes, and later stage is a much higher percentage of equity, specifically in the Series A and above. And then this is just high-level analysis from CapShare. Data is a little bit older, but I wouldn't expect it to change significantly for what the dilution is per round. And so you can see at the beginning, when you have common and convertibles, the founders still have all the equity. Those convertible notes have not actually converted. Once you get to the seed round, that's more typically a priced round. And so your convertible notes and your safes will convert into equity. And so you have that dilution, roughly about 25% by the averages. And then you continue to dilute stage by stage. Now, you can get yourself in a little bit of trouble if you are not understanding the mechanics and the math behind your safes. And so there's other video and content on how to run those calculations. But as you're thinking about your rounds, just make sure you're not over-raising on safes, because each round that you raise, you need to make sure that you have the right amount of debt. You're not getting too much debt on the cap table, because then it may actually make it more difficult for you to raise a seed. So that separate, slightly longer discussion, but that's a little bit about dilution. You should certainly think about that. Each round, as you go from pre-seed to seed to Series A, you're seeing like a 5x valuation bump oftentimes from pre-seed to seed to Series A. And that's usually commensurate with some de-risking, some key de-risking of the business. And so certainly there's some technology companies, there's some deep tech companies that are building biotech or pharma or medtech or FDA type devices where they're not really going to see any revenue for quite some time. But for B2B SaaS companies, consumer companies, CPG companies, you're more likely to see some amount of de-risking as you go along. And so you'll start with pre-seed usually being 0 to maybe 15, 20K in monthly revenue. But it's often non-existent. If it does exist, it's often lumpy in individual deals that may be valued 50 or 100K. But then there's kind of like blank spots in your finances. And you're typically raising money to get that initial product, initial paid users, initial momentum, maybe hiring some of the early team members. At seed, you're starting to see a little bit of revenue, again, 10 to 100K. You're seeing some repeatability, but often there's some geographic concentration risk. There's either customer concentration, maybe you have only 1 or 2 customers, maybe some geography concentration. It's only in one geo or state, but there's some other unarticulated risk within the revenue and how you're selling to customers. You're typically raising money for the next round, which is to increase your predictability and show that there is some ability to scale and track revenue over $1 million in annual recurring. And then, of course, Series A goes beyond that as well. Typically, revenue is over $1 million ARR, and you're increasingly showing that you can continue to scale well. Key takeaway that founders should really understand that it's not about the current round, it's about the next round. And so you should really be thinking, okay, if I'm in the pre-seed convertible note phase, how do I make sure that I'm positioning myself correctly for the next raise, the seed round? If I'm in the seed round, like what are the articulated goals and goalposts that I need to hit to properly get to the Series A round? Along with all of this, it's really about building a great business. And so, you know, this is maybe side commentary, but the goal of venture money is to build successful companies that generate profit and revenue, create liquidity for both investors and the founders. And so make sure you're building a great business. Again, this particular talk is about how to raise capital from venture capitalists, but it's really about building a great business. And oftentimes you may not even need as much capital for venture capital to grow that business. So really be strategic with your current raise, with your next raise, and positioning, so you're not kind of getting over your skis in terms of valuation or how much money you raise. Um, this stuff is really hard. It's often not talked about. So just networking with other founders, preparation can really help you in the fundraising process to really understand what you're doing. Common mistake people make is that they articulate that they're raising capital to pay for the next 18 months of burn, to hire people, to build or add features. And the key thing to understand is that investors don't really want to give you money to staff up. The goal of the money isn't to fund that burn. The goal of the money is to de-risk the business. Investors don't want you to just use that money for staff. They don't want staff, they don't want features, they want higher valuations, and they want lower risk of failure. Right? As an investor, I want the company to be worth more. And so explain how the company will be worth more. Fundraising gives you the tools to reduce risk, to achieve significant business milestones. So if you have one customer, maybe that capital is going to get you to 5. If you have 5 customers, maybe that capital is going to get you to 10 or 1,000. If you're regional, it's going to help you go national. If you're national, it's going to help you go global. If you know some of your numbers, like customer acquisition costs or your lifetime value or your churn, the capital can help you improve those metrics. And again, that makes the company more valuable. If you are thinking about defensibility or moat, you can use IP or patents to reduce the risk in your business, to make it more valuable by having IP and patents. If you are trying to continue to grow, you may want market dominance. And so you may be building a data moat or another technology moat or other barriers to entry so that your company is more valuable. So lots of things to do there. Fundamentally, founders should really understand that raising capital is sales. And so you should really think about it as a sales process. So if you've sold anything before, there are equivalents in equity raising. And so essentially you should think about it where your investors are your customers, your product is equity, and the price you put on that equity is the valuation. And so a customer's product price is entirely sales. And if you orchestrate it as sales, you will be much more successful. This sales process typically takes anywhere from 3 to 5 months. It can take longer if you are selling more, if you have a larger deal, more equity to sell. It can take less if you're only trying to raise a couple $100K. But high level, you should think about it as sales. And it will require a lot of your time. And so let's jump into it. There's a number of things that you can do to improve that sales process to make it more predictable, easier for you, easier for the investors as well. Number 1 is preparation. Number 2 is socializing. Number 3 is pitching and storytelling. Number 3, getting commitments. I lost count. It's probably not number 4. 1, 2, 3, 4, 5, getting momentum, and lastly, term sheets. So in terms of preparation, it's important to have all the information that you're going to need in your fundraising process before you even get going. If you have all the stuff in place, this is called mise en place. So if you're a cook or a chef, you put all your ingredients in place. This is how when you arrive at a restaurant, they can prepare a meal very quickly, whereas it may take you an hour in your own kitchen. It's because they've done hours of prep work before you even arrived at the restaurant. And so you as a founder should do a ton of prep work. So that way, when investors arrive and you're having those meetings, you are ready to go. And so a lot of stuff you can prepare, a data room, an investor pipeline, a CRM, forwardable emails, teaser decks, meeting decks, financials, and cap tables. I'm not going to go too deep into each one. I will lightly cover each one just so you get a sense of what these are. But largely, a data room is a place where you will store important documents and information about your business and your company. This can be legal agreements, these can be IPs, patents, sales contracts, other things that you may want to share. You're not necessarily going to share everything, but you want everything in one place that if you do want to share it, it's ready to go. You don't have to go searching for it. Number two, you want a cap table ready to go. At the very minimum, you can certainly do this in a spreadsheet, and often founders start with a spreadsheet. I should mention that both AngelList and Carta will offer founders a free cap table tool if you have raised under $1 million. I highly recommend these. It just makes you look significantly more professional as a founder. It means you have your stuff together, your numbers, your data, your information around your cap table. You will just look so much sharper. Now, these tools do cost money, but they only cost money after you've raised the first $1 million. So they really only start to impact your burn and only a little bit after you're into your seed round. Now, when investors are investing, my head's over the Carta label, but move myself there. So AngelList and Carta. When investors are investing, I like to say they invest in 3 different stages, and the stages are really number one. Let me move myself down here, over here. I'll be between here. I'll look this way. Boop. um, so number one, they invest emotionally, and so the first investment is that investors want to care about you. They want to care about the problem that you're solving. Number two, they want to care. You want investors to care intellectually. And so this is usually when investors invite you back for a second meeting. They're starting to ask slightly deeper questions. Maybe they're meeting other folks on your team, but they're getting a little more into the business of what you're actually doing and how you're doing it. And number three, that's when investors will ask financial questions because they're choosing whether or not to make a financial decision into your business. And so this emotional investment, intellectual investment, and financial investment is how founders should think about it. And so the key thing is to get an emotional investor, you have to target people who care about your particular problem. The way you do that is by creating an investor research list. And so how do you do this? There's a lot of resources online. There's a lot of databases, LinkedIn, AngelList, Crunchbase, Airtable lists that list all sorts of investors and some of the things that they invest in. It's up to you as the founder to do your research. Again, this is sales. Like, how do you sell anything? You have to research your customers. Who are potential customers who would be interested in your product? Your product is your equity. Who are the potential investors who might be interested in your product, your equity? So do your homework on different investors and what they're interested in. Second thing I recommend when you're doing that research is consider investor diversification. We have a big world. If you're an East Coast company, I often recommend make sure that you're looking for investors, not just on the East Coast, but on the West Coast as well. If you're a West Coast investor, make sure you're getting diversity and you're getting some investors on the East Coast as well. By getting diverse investors, you will maximize your probability of getting better valuations, and you will maximize the probability that you will get better customer connections, better introductions to help your startup grow. And so identify the potential investors, put them in a spreadsheet, and high-level recommendation is, don't put anything proprietary in that spreadsheet. You want to make sure that that spreadsheet is shareable so that if there's another mentor or another investor or someone else in your network who you trust, or let's say you get that first angel to invest the first check in your business, you want to be able to turn to them and say, hey, I have a spreadsheet of a bunch of other investors who I think would be great investors for me. Can you take a look and let me know if you can make any introductions to any of the people on my list? And so again, mise en place, when you have your ducks in a row, when you have your investor list together, that process is way easier. Again, if you get your first angel check and you're like, hey, can you make any other introductions to other investors? It's a very kind of open-ended question. They're not necessarily going to even know who to ask or who to go to. But if you can share with them a spreadsheet and say, hey, thank you so much for committing 10K into my round. I really appreciate it. Can you take a look at my list of other investors and let me know if there's anyone on the list who you recognize or know. I would really appreciate using your name to get those introductions because it'll be a better introduction. So definitely by getting prepared, you improve your probability. Next thing I'll say is organize your list BAC. Why BAC? Well, A's have better deal flows than B's. And so when I say A's, it's not necessarily mean like the best, most prominent investors in the world. These are the investors who are best for you. They're best in your sector, in your market. They are best in your geography. They're best in your industry. And so if you get some of the B's initially excited about your company, they're going to be more likely to make those introductions to the A players in their industry because they want to co-invest together. And so typical strategies go BAC. Obviously, you need C's to put a little bit of pressure on closing of the round. But if you just kind of scattershot A's and B's, or you start with your A's, the A's don't necessarily have a lot of pressure. Whereas if you get B's interested, B's are hungry for that deal. They're going to be excited. They're going to push it up to the A's. It just improves the probability. Now, I talked about having an investor research list. This is something that is shareable. It doesn't have a lot of information on your notes or the meetings or how they went or action items or things like that. You also want to have your internal investor CRM. This is kind of your database that says, oh, this investor sucks, or this is the name of his or her dog, and this is the favorite snack, and this is where he or she likes to drink their coffee. And so you want to make sure this is something that you have in place so that you're really good about following up. When you are running an investor process, you may be reaching out to 40, 50, 100 different people. And so if you don't have some type of CRM, it doesn't have to be complex. It can be a spreadsheet, but you need some type of system, some type of CRM to keep track of this stuff so you can really be on top of the game. Now, next part of the process is pitching and storytelling. I'm not going to go too deep because there's a ton of other videos that talk about how to pitch and how to storytell. I'll very quickly say that I really like what's called the Pixar story spine. And the idea behind the Pixar story spine is that if you go watch a Pixar movie, all Pixar movies use the structure where the producers or the writers for the movie will tell a quick story, and it starts once upon a time there was blank, and every day blank until one day blank, and because of that blank until finally blank, and every day since blank. And this structure has been used in Toy Story, it's been used in Up, it's been used in Nemo, a bunch of other things from Pixar, and it really, really works because it outlines the arc and it really well aligns with what is typically a pitch. And so once upon a time, there was a huge problem, and everyday current solutions didn't work until one day we discovered something. And because of that, we built a solution. And because of that, we got traction until finally we made a difference. And now we're executing on that huge vision. Again, there are other ways to do a proper pitch. And again, I'm kind of paraphrasing this quickly, but make sure you have your pitch together. Now, next step is getting commitments. So you have investors, they've had a good conversation with you. Maybe they've had a first meeting or a second meeting, but they're not quite committing. They're not wiring the funds. They're kind of hanging back. And why is that? Well, largely additional time does not help you, the founder, but it actually helps the investor. As more time passes, the investor learns more about your business. And so the opportunity, the valuation to invest typically doesn't change 30 or 60 days after they've met you, after they've took an interest in your company. And so time reveals additional either traction or unarticulated risk. And so investors also don't want to be the first one in the pool. And so typically they will push and wait even if they're interested. And so when do investors like to invest? They like to invest like when they're the last 50K, the last check in the pool. They want to be the last ones in, not the first ones in. And so there are 5 tools that I like to talk about that kind of help you with this. One is scarcity, urgency, exclusivity, optionality, and momentum. And I'll kind of hit each one at a time. So let's take 2 scenarios. Scenario 1, you're raising 200K. maybe you have a little bit of commitments, maybe at 50 or 100K. And so you can articulate, hey, I'm raising 200. I have commitments for half of it. In option 2, let's say you're raising $1 million. And again, we can either pretend you have no commitments, or you can pretend you have that same 100K commitment. Which one presents as scarcity? It shouldn't be too hard. Like option 1 is going to feel like that opportunity is closing. Like there's just not that much allocation left. 1 or 2 people in that round could be closed. Whereas if you're raising $1 million and you only have either no commitments or you have 100K, it feels like there's still a very long way to go. And so one thing founders can do is, it's easier to raise more. It is harder to raise less. And so if you start off raising 300K, 400K, 500K, and you find that it's going well, that round is filling up, you have 400K, you have 500K, now you're oversubscribed at 600K, you were only planning to raise 400, 500. It's easier at that point to make the decision that you want to raise more. On the flip side, if you're raising $1 million, you're finding you're not getting a lot of traction. Maybe you have 50K of commitments, 100K of commitments. It's going to look like you don't know what you're doing, like you had a bad plan and then weren't able to execute the plan. If you then go from, oh, I was going to raise $1 million, now I'm raising half. And so think about scarcity and how you can use that. Like I said, it's easier to go up and raise more. It is harder to come down. Number 2 is urgency. And so there's a term called calendar packing. And the idea, and there's a great blog post on this. I'll try to link it. If you run a tight process, it creates urgency. It creates pressure on investors because there's always another meeting right behind the one you're currently having. You don't have to wait for that investor to say yes or no. You just continue to plug away. Most founders, they run a relatively loose process, and they'll reach out to a couple of investors, they'll have a couple of meetings, but they're spread out over 3 months, 6 months, 9 months. So there's not a lot of pressure on the fundraising process. There's not a lot of pressure for any one investor to either invest or not invest. And so because there's zero pressure, it's a loose process, it continues to have low pressure. And so by tightening your calendar, and again, doing your preparation all at once, sending out all your initial emails, or trying to pack some of those first meetings together, trying to pack some of those second meetings together, you're in effect creating a little more urgency, a little more calendar density. And the other thing that will happen when you run a calendar dense process is investors will talk to one another. Again, a lot of investors will talk. It is a community. And so if a particular company's fundraising, is not unusual for investors, especially at the same stage, to talk, hey, did you hear this company? Are you going to be in the round? What do you think? Oh yeah, I'm interested in investing. They're coming back for our second meeting. I'm bringing them to the partner meeting. When you run a tight process, everyone is talking about your company, and it puts pressure on that closing. And it also puts pressure on the valuation, again, especially if multiple VCs show an interest in your company. Number 3 is exclusivity. Again, if you cast a really wide net, whether it's for angel investors or venture capitals, and you say, look, I'm looking for any angel investor, it doesn't feel super exclusive. And I've certainly gotten a lot of pitches like this where, hey, I'm looking for an angel investor. I'm like, okay, but I'm like, I don't personally have an interest in ag tech or crypto or some random technology. Like, why me? Why did you choose me? Whereas option 2, I'm looking for angel investors who have experience scaling B2B SaaS companies, who are ideally former operators. Again, that's a very specific example, but when you are specific with who you're looking for, it creates exclusivity. The investor on the other side knows why you're a good fit for them, and they get excited because they see that fit as well. They're like, oh, I could really help that company. Investors, obviously they want to make money, but they also want to have an unfair advantage. If they feel that their experience gives them an unfair advantage, they get more excited. Number 4 is optionality. So when you as a founder have options, it makes it more interesting. It puts pressure on the deal. If customers are willing to pay you, if you're generating profits, if you have pre-orders, if you want an SBIR, if you can do alternative financing, what investors hear is that you're not going out of business and maybe you don't need them. And ironically, when they hear that maybe you don't need them and you're not going out of business, that's exactly when they want to give you money. And so make sure you think about the optionality for your investment round and how to articulate that as well. And lastly, like momentum. And we talked a little bit about this as well. Once you start to have momentum, once your deal starts to feel like it has momentum, it gets way easier, specifically after you get over that 50% line. It feels like existing investors will make introductions to new investors. Those new investors feel the momentum of the previous investors, and so they get excited. The scarcity of that round starting to close creates additional exclusivity, more referrals, more commitments to invest. So I've seen this a number of times where a founder is having so much trouble with the fundraising process. They're pushing that boulder up the hill. It feels insurmountable. And at a certain point, things start to click and they're like, oh my God, my round closed in 2 weeks. And that's because of that momentum mechanic. So I'm going to pause there. That's the basics of fundraising. Obviously, there's a lot more to it, but hopefully this gives you a primer on some of the things to think about in terms of getting your ducks in a row and getting investment. Key advice is do your preparation work. And so if you do your mise en place, do your investor research, understand who you want in that round, that's going to make it much easier for you to run a tight process, to put calendar density, to put pressure, to put exclusivity, to generate momentum, to generate fear of missing out or FOMO, and hopefully help you raise the capital you need to de-risk the business and make a big impact on the world. I'm Greg Raiz. I talk about technology, entrepreneurship, and design. I hope I'll catch you on the next one.